Good morning, ladies and gentlemen. Matt McGlay here. Today, in part one of the Wyckoff series, we're going to be covering Wyckoff Price Cycles, the Composite Man, and Wyckoff Trading Channels. With your understanding of these concepts, you'll be better able to predict, understand, and read the market cycles, charts, and movements. All right, the Wyckoff method. In today's series, we're going to just go over kind of the gold nuggets of a few of the concepts in the Wyckoff method and ideology. There's been numerous books written by Wyckoff himself that I suggest you read and enjoy and get firsthand knowledge on them. But the point of these series, like I mentioned, just to give you those gold nuggets to help you plant some ideas and help you start building a foundation for your trading strategies. Let's jump right into one of the fundamental principles of the Wyckoff theory, the Wyckoff price analysis. Wyckoff price analysis is composed of a few basic components. The accumulation phase. This is when institutional investors have found a price that they like and they're starting to invest into it. They're starting to slowly buy up more and more and more, making sure that they're not stimulating the market too much and causing people to get suspicious and the price to rocket. They're trying to buy just enough to keep it within a certain price range. After that, there's the markup period. This is once they've accumulated enough wealth within the market, they're starting to drive it up. They're pushing up the price more and more and more and more and more and higher and higher and higher. And this is causing a compounding effect. People start seeing the markets going higher, then crowd psychology and market and the hive mind of the stock market start saying, oh, price is going up, I need to jump in. So everyone starts jumping in and starts buying and buying and buying, causing the price to go higher and higher. And then once they've reached their price, where they think that they've accumulated enough wealth, we move to the other phase, the distribution phase. This is when they start selling off their assets in the exact same fashion, slow and steady, enough to not cause the price to go down, but enough that they're getting rid of their position as quickly as possible. Let's look at an example here. We notice that the market here has crashed and came down to a very low price. At this point here, this is what's known as the accumulation phase. The institutional investors and smart money are starting to purchase up as much assets as we can. Notice the volume below. Volume is skyrocketing. It's literally off the charts here at some points. And now what we're noticing is that we see a markup phase. The market starts rising in price. Price starts going up higher and 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 higher. But notice what's happening with our volume. Our volume is a consistent downtrend. The institutional investors and smart money have already bought up everything. And at this point, they're just slowly selling off percentages of their assets. Price goes up, they sell off a little bit. Price goes up, they sell off a little bit. Price goes up, they sell off a little bit. And then once they get to the very top, they've literally sold off all their assets and there's no more volume or liquidity in the market, theoretically, in the sense that smart money and the movers of the market have already sold off all their positions and they have no further need for the market to go up, which is going to cause a stagnation, an absence of the volume going up, and is going to cause the market to start crashing back down. Pay attention to these pivotal points right here where we have these sell-offs. Here's an initial market sell-off. We can also contribute to this as the Wyckoff spring. Volume's not too much, but once the price has gone up a fair amount, our first down trot, look how massive the volume is. Volume drops down immediately when the price starts rising again, and then our second fall down, massive spike in volume, a massive sell-off. Everyone's like, oh, double top here, price go, boom, sell, 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 to the point where once again, we're at very low volume compared to the accumulation period. This leads us into our next concept known as the composite man. Wyckoff, during his years of experience, formulated this concept that there is a group of highly skilled investors. These titans of tradings have the ability to shape the market and completely control prices. This is the concept that we're talking about, smart money, the intelligent investor, the whales of the market. All the fluctuations in the market and all the various stocks should be studied as if they were the result of one man's operation. Let us call him the composite man, who in theory sits behind the scenes and manipulates the stocks to your disadvantage if you do not understand the game as he plays it, and to your great profit if you do understand. Here we have Tesla. We've noticed that there's ups and downs and movements, and it's kind of chaotic at first sight. But with our use of the Wyckoff composite man, let's examine it through these new eyes that we have. We see through here, right at the beginning, There's a massive amount of volume. This is smart money accumulating all of their money. They're starting to buy up in the stock. They see there's huge potential. They understand, they know where this is going. You can even call this inside trading. It's illegal, but it happens. These are concepts that people in the back, they understand what's happening through the market. They're starting to accumulate. They accumulate. Look at the volume. Now the volume starts going down. It's going down, 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 down. What happens is the price. Price starts rising up. Smart money's starting to sell off their money. They're starting to sell off all the profits that they made. Once they've secured their profits, now they're testing it. They're in the region again. They're seeing what's going on here. Is the market moving or is it creating? Is there more room for growth? They see that the market has a lot more room for growth. What happens to volume? Look at volume. Volume starts going back up. Volume starts going back up. They start buying. Momentarily right here, they buy a lot, then they sell, causes price to go back up. Now we're in this region again. So look here, let's notice a couple of things here. We see what's happening here here's another thing with smart money, the composite man. We see there's areas of support and resistance here, but we notice these massive fluctuations. This is what we're looking at, is what we'll cover more in depth in the next series, in the next part 2, is the composite man messing with the 97%, the weak money, the scared money. They're fluctuating up and down. They're trying to scare people out from buying and selling, seeing how they're reacting. And then look right here what we notice. There's one massive downtrend that scares out all the money. And what do the people do? They buy. Look what's going on right here. Massive amount of volume buying. They're buying in this region. And what happens after this huge scare where they scare out a large percentage of scared money? People that have only a couple $1,000s, or even maybe they have hundreds of thousands of dollars, but they're so irrational and they're being driven by their emotions. They're like, oh no, Tesla's going down. Tesla's out of business, blah, 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 blah. Some news headlines popped up, whatever. They sell all their assets and then they just buy them up cheap. They know exactly what they're doing. Buy them up cheap, boom, price skyrockets. And look what happens here again. Rinse and repeat. Market goes up. Boom, 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 boom. Massive scare out. Bam. Market skyrockets to unbelievable record highs. Last, in part 1 of this series, we'll be discussing Wyckoff channels. Wyckoff channels are a fairly simple concept which revolve around the idea of trends. Here we notice we have an uptrend, and then here we see we have a downtrend. Wyckoff stipulated that these trends form certain channels that they operate within. So let's analyze this uptrend here. First, we start noticing some swings high and swings low. And it keeps reaching a certain point and then going back down. Reaches a certain point, goes down. Reaches a certain point, goes down. So if we draw a line of resistance here, we start noticing that every time the price hits this area, it tends to move back down. And then if we look on the other side, we draw an area of resist or support. We start noticing that every time the price approaches this area or heads into this direction, it starts like a magnet being repulsed by it and pushing out of it. This is what's known as the Wyckoff channel. If we look at the inverse and we look at the downtrend, we can see the same phenomenon occurring. Here, we start noticing that every time the price starts approaching this area, it hits resistance. And then every time it starts approaching this bottom level of the channel, it starts reaching support. Wyckoff's theory is that these prices start fluctuating within this area and they operate within here. And whenever we see deviations from these areas, they're either very temporary, as we notice these candle wicks here, or it's an indication of an end of the trend, as we can analyze and see within this first example here, that as soon as this channel was broken, price fluctuated in this area and it kept going. That was the end of this channel and the downtrend began. Hey guys, hope you had fun and enjoyed the video. If you found it of value, help me out and hit that like and subscribe button. If you want to follow me on my other social media sites, check me out on Twitter and Instagram at Matt McGlay. Link in the description.